Hi everyone, and welcome back to another trade review video. This is the second video in this series where traders that have contacted me to take a look at their trades have given me permission to mark the chart up again with their entries and exits so that I can review it in a video and we can all learn from it. So there's nothing personal here. It's all about looking at technique, looking at execution, looking at how the trade played out. I couldn't care less whether the trade made money or not. Now, I have the advantage that I can see the whole chart. I understand that as well, but I'm going to do my best to go through in the same process each time. Now, I spend a lot of time reviewing my own trades, and one of the biggest changes in my development from a horrendous trader forward was taking more time looking at my trading mistakes. At first, I thought I had 100 different mistakes, but actually I found I had about 7 categories of mistakes that I kept repeating. So let's get into the first trade today. Let's follow the same 4-step process: market cycle, entry, scale in add-ons, and exits. Well, we've got a very strong bear spike. This is the high of the last leg. That's a new low. So if a bear had their stop there, that stop got run. We're always in short. This puts the market into a trading range. So my first comment is it's a bad idea to load up on buy entries in the top part of a trading range. So the structure of this trader's entries and the sequence of them show that they thought this was a very strong breakout, a very strong reversal, and the trader thought this was going to happen. But if you look back to the left, we just made a new low. This is a lower high. There's a chance this is a double top bear flag. If you look at all of this as a spike on a higher time frame, like the 15-minute chart, this is a low 1 sell. This is a pullback, and this is a low 2 sell. And that point, and if I take that line across, you can see that the market thought that was the sell signal and we're testing. So from a market cycle perspective, the trader has seen a strong reversal and tried to buy a pullback, not realizing we're still under the moving average with very strong bear bars. Now, can a trader trade this as a reversal? Of course. But if this is a reversal and I'm in a bear environment, I'm looking to buy a reversal. That's 1, that's 2. That high 2 buy signal is too high in the range. So if I wanted to participate in a reversal, I can't buy above a bull bar here. I'm also not going to buy above this bull bar because it's even higher than that one. The first time I can get long is actually below a bull bar down here. I'm waiting for it to go down to the bottom 50% to see if I get an entry. So the first entry would have been here. It had no follow through once, twice, and it looks like everyone got out. So in terms of market structure, breakout, pullback, low 1, low 2, the trader can spend a bit more time. Let's look at the entry. Well, if I get my magnifying glass here, so you can see it on the video, what entry technique did that trader use? Buy the close or buy 1 tick above? They bought the close. So just like on the previous trade in the last video, traders are trading in a reversal, but they're not using a reversal entry. The arrow should be up here. They're actually buying at the moving average when we're under the moving average. So they've used the wrong entry type. Let's also talk about add-ons and scaling, the third part of our series. Is this a good add-on if I've already bought there? No. Perhaps they made an error and they were on the wrong size, and so they added to get to the right size, but you shouldn't be adding multiple times in the same bar. You should enter, wait for more information. Your entry bar is a bear bar closing on its low. Typically, if I'm trading a reversal, I want to see immediate follow through. I get a bear bar, I get a bar against me, I'm going to exit below that bar because I might be looking at it wrong. If we look here, where bears were selling 1 tick below that low, this trader actually added on. So they're acting at the right part of the chart in the wrong way. If you bought here and added on here, these are all emotional panic entries. If I had bought a bull bar there and I'm looking to scale in, the first time I can scale in is going to be below the bar. So if my entry is there, the first scale in is going to be there. But considering I'm so low in a trading range, it would typically be at the low of the trading range. 1 contract here, 1 contract here, the midpoint being right in the middle here. That is the safest way to trade a trading range if I ignore the fact that there are sell signals that are live. The moment the bears made a new low, this is the signal to get out of a long trade. If you want to buy during a bar, a 50% pullback, well, the bears were doing it on the way down. Here is a sell signal. You can sell 50%. You can sell 50%. Selling 50% of this bar was not a good idea. But looking at the whole spike and selling 50% of that entire spike was a good idea. So that's probably what 15-minute traders did. Now, what about the exit? Well, you can see they probably traded too heavy, panicking their way out of this trade. And by exiting right at the low of the trading range, it's clear they were not aware that they were in a trading range to begin with. So that exit should have actually been at the lows and not during that bar. But it looks like they saw 3 consecutive bear bars and thought, yep, that's enough. So a really great learning example for all of us to say, okay, what kind of market structure am I in? Am I in something bearish? Is it a pullback? I've broken a swing point, but I'm still in a trading range. I must trade it like a trading range. Just because I've got a good looking buy signal up here doesn't mean all of a sudden it's a strong breakout. Now let's have a look at the second example. So once again, you can see multiple scale-ins during the bar. Now these are different traders, but this is something really common that I see in people's trades, just relentlessly adding on in a particular direction instead of getting out and taking the loss. So market cycle is step one. Well, we're in something bearish and we've just broken out here. We've got to break out and follow through. So this is now a buy signal up here. So the trader didn't understand the market cycle. They understood the market cycle. The sells would be down here. The sells would be down here. But by trading a breakout pullback, they missed the fact that this is not a breakout. We did not close below that range. Many traders will not trade that as a breakout, particularly not after 5 bull bars. So market structure, that's a no. We can also see by taking 2 entries in the same bar, this might have shot all the way down to the low and they've panicked to try and get in thinking they're going to miss. What did they do when this bar closed? As we're going up, a trader sells here. That's the only reasonable sell instead of these ones. But if you sell there, where's your stop? Your stop probably needs to be 1 times above that bar, somewhere up there. So the fact that the trader is continuing to sell as we go up, and then when this really strong bull bar closes, what do? They sold the close of that bar. That's an incredibly strong bull bar closing on its high, breaking out of this entire range. That is the exact opposite of what you want to be doing. If you're short, you're exiting here or you're getting out of the trade there. You're not. So if you're short and you're exiting a short trade, you're getting long to get out. If you're flat, you're waiting for a breakout of follow through, and then you're getting long up here, which was the midpoint of this trading range. The good news was this trader realized their mistake once this got follow through. So that exit means the trader understands they were doing the wrong thing. What would have been even better is to see a second trade actually getting into this long position or trying to buy a pullback, trying to participate in 50%, looking to make money back in this direction. So a common theme, intra-bar scaling, just aggressive adding on to an entry that's not performing and no clear place to exit. That means the trader has a lot of euphoria that the trade is going to work and they're not prepared for the extreme opposite bar. All the good traders that I know have a very clear mental picture of what the trade not working looks like, and they do not hesitate to get out. Whereas as a newer trader, we get emotional. We think we can just add more positions to get out instead of taking the loss early, getting back to flat, and then trading in the new direction. So I appreciate that trader sending that trade in. Let's have a look at our third and final trade for this video. Well, a super common trade, this one. The market is going higher. You see 3 bear bars and a trader starts selling. Then they start selling above bear bars. And then at some point they realize it was a bull breakout, a pullback, and we're going higher. Easy to do, and I've done it many times. So let's go through the process again in our 4 steps. So step 1, what's the market structure? Well, here's a tight trading range. Here's a breakout. Traders are waiting for a bull bar to buy above. There's 1, there's 2, there's 3. These are all buy signals. And we can see this trader is spending a lot of time selling as these high probability signals are triggering. So the trader is not confident in this part of the market cycle. We can tell they're looking at the small amount of risk. They were not happy putting a stop down here or down here. And that tells me that this size is probably too large. What about is the correct stop entry? 1 tick below this bar. So that first entry is okay for reversal. I think if you're trading a reversal in a bull environment, you actually need to enter early to make sure that your stop is small and your target is big enough, because a lot of them are going to get out of the moving average, which is what happened. I think the better entry is usually above a bear bar, which gives you at least 1 to 1 or 1 to 2 to get out. So this entry was okay. This entry was a mistake, particularly if you've already entered there. You don't want to add on lower at the moving average. The market probably rushed down, and that tells me the trader did not see the breakout pullback test. I think it would have been better the trader waited for the gap to close and then sold higher, betting there would be a second leg down. But more experienced traders see the breakout pullback test, see a buy signal, and now they know anyone that's doing the opposite is going to start losing money. So that was on the entry. What about the add-ons and scale-ins? Well, this trader, as well as the last few, just adding way too many positions. Adding too heavy here, there's no reason to sell above that bar as well if you're here. If you're selling here, the scale-in's going to be above there or up here. There's no mathematical advantage of selling here, selling during intra-bar. Here's consecutive bull bars. There's no reason to sell the close or above that bar. All the bulls are doing exactly the opposite. I would have expected the trader to get out one tick above the high of that bar, but they panicked out during this bar. So that tells me either the size was too big or they were not prepared for this trade to lose. So they didn't understand it was low probability. That is a common mistake. And Dr. Al Brooks talks about it a lot in his course, showing how we're able to be in a bull trend all day and take losses selling all the way up. And I've done it many, many times. So I really appreciate the traders who sent those in. And I think they're great for us all as reminders on how we're supposed to improve the probability of our trading, as well as focusing on executions. Well, thanks very much for watching. I hope you found that valuable. If you'd like to send in your trades, and once again, I remove all the notes from those charts and I re-put them into this software so that we can just have a look at the entries. Please put a comment in the video below and we'll get in touch. Till next time, thanks very much for watching. My name is Tim Fairweather from Zen Trading Tech.